in the domestic bond markets. The yield, even on the new 10-year benchmark bond, have now moved up to 740, 13 basis point increase in bond yields yesterday. 744 or so is where they've closed. Sort of reiterated one of the first charts in the economic survey, which talked about two assets, two messages. The divergence between equities, which are focusing on a revival, and bonds, which are focusing on the risks that are emerging. Now, I think perhaps a couple of things spooked bond markets yesterday, or maybe they did. One was the talk of a pause in fiscal consolidation, but that was talk of the current fiscal year. I presume the bond markets already know that meeting the fiscal deficit this year is going to be challenging. Also advised a prudent policy on fiscal consolidation going ahead, perhaps into next year. Apart from local factors, global bond yields have been on the rise as well. The US 10-year moving closer towards 270, and that could be another factor impacting domestic markets. Let's get in a view on the bond markets. R Sivakumar, Head of Fixed Income of Axis Mutual Fund, is joining us on the phone line. Good morning, sir. Thanks for taking our early morning call. What happened yesterday? What got bond markets worried yet again?
The 2 points that you made in terms of worries on fiscal consolidation and, of course, the global, both have weighed on the market. I would say that the fiscal consolidation fears have ruled the markets for the last several months, and to that extent, the economic survey making it a little bit more explicit that they may need to pause the fiscal targets relative to 2017, I think is the key reason for this sell-off yesterday.
But sir, what specifically? I mean, so they talked about the fact that, there could be a pause in fiscal consolidation, but I got the sense that they were talking about FY18. So that the market already knows, right? I mean, did they read into the language to suggest that there is, perhaps a 3.2% number coming for next year, or what?
So I think there are two parts to this. One is when you look at the language, it says a pause in fiscal consolidation for the general government deficit related to fiscal 17, with the states further consolidating. That is to say that there's a possibility which is acknowledged that the center may actually have a higher deficit than it was in 2017, which I think is the first acknowledgement that we are not talking about a pause for the center, but perhaps a breach of the previous year's number. And that certainly has worried the markets. I think the expectation was, even in an adverse scenario, to have the same number as the previous year. So I think there is some fear that the fiscal breach may be larger than anticipated. We must also remember that 1 year's breach has knock-on effects. To give an example, if we reach at the end of this year at 3.5, it is very unlikely that fiscal 19 will directly go to 3.0, and you may again have an intermediate stop of 3.2 or 3.3. So the entire process of getting to 3.0 fiscal deficit is pushed forward maybe a year or two.
Mr. Sivakumar, there was a box item in the economic survey which tried to explain to the markets that higher government borrowing does not directly correlate to the underlying fiscal deficit, bringing the National Small Savings Fund into play. Did the market take anything from that?
No, I think on balance, if you look at the collections under the NSSF has, I think, broadly tracked what the estimates were for the current year. So to that extent, I'm not sure whether that is the swing factor for this year. Much more importantly, as the survey acknowledges, the states have cut back on NSSF issuances, which means the states are tapping more from the market. And we have seen that over the last couple of years, the spread on state development loans having climbed as a result of higher issuances. And today, in fact, you find some corporate bonds, the PSU AAA corporate bonds, for example, yielding lower than sovereign securities. And that's just the reflection of the extreme pace of issuances by some of these states. And I think that is what the markets are worried about. It's the aggregate borrowing. We have higher borrowing by the states. We also have higher refinance. I mean, obviously, there's 2 lakh crores of maturities, which means that needs to be refunded. So the gross borrowing number is higher. And lastly, of course, the RBI is supplying about 90,000 crores through OMO. So when you look at the overall supply, all of these aggregates together.
Just a last quick question, Mr. Sivakumar. Then what are you anticipating on 10-year bond yields, keeping in mind also what is happening on global bond yields, sir?
So I think the global is not going to be the driving force. I would say over the next several days and maybe weeks is obviously going to be the pace of Indian borrowing. We are looking at a gross borrowing number somewhere in the excess of 6.5 lakh crores for the center. And we are talking about a number maybe 4.5 lakh crores or thereabouts from the state. So we are talking about close to 11 lakh crores of issuance next year. And that will start hitting from the first week of April. I think that's what the markets will be looking at over the next couple of months.
All right. Thank you so much, Mr. Sivakumar. Appreciate you joining us with that quick take.
Thank you.